Most people who invest in stocks focus on one thing, the price. Buy low, sell high. Watch the price go up. Exit at profit. But here's what most beginning investors completely overlook: stocks don't just make you money when the price goes up. Some stocks pay you money regularly just for holding them. So, this payment is called a dividend. So, and the best dividend paying stocks in India do both. They pay you regular dividends and their stock, and also price goes up over time. So, what is a dividend? So, when a company earns profits, it has two choices. Choice one is to reinvest all profits back into the business for growth, and choice two is share a portion of profits with shareholders as dividends. Established, profitable, cash rich companies choose option two. That is because they have already built their business and generated more cash than they need for growth. So think of companies like ITC, Coal India, HDFC Bank, Hindustan Zinc, Balrampur Chini, Power Grid Corporation. So these companies generate enormous cash profits every year, and they share a significant portion with shareholders as dividends every year reliably. So uh, who should care about dividend investing? Is everyone, but especially salaried professionals who want a second passive income stream, retirees or near retirement individuals needing regular cash flow, long term investors who want to be rewarded for holding, not just trading, anyone who wants to reduce the anxiety of watching stock prices daily. So, dividend investing is not exciting, it's not viral, it doesn't make headlines, but it is one of the most consistent, stress free, and proven wealth building approaches in history. Now, let us see how dividends work. Okay, so let us see how they work. So, let's understand exactly how dividends work from companies' earnings to bank account. Step 1: the company earns profit. A profitable company, say ITC Limited, um, earns massive profits every year from cigarettes, FMCG, hotels, and agribusiness. Step 2: the board of directors declares dividend. The company's board of directors decides we'll pay rupees X per share as dividend. This is called the dividend declaration. Step 3 is key dates you must know. Dividend declaration date: the day the company officially announces the dividend, and record date: the date on which you must be a registered shareholder to receive the dividend. If you own the stock on or before this date, you get the dividend. Ex dividend date: one day before the record date. If you buy on or after this date, you do not get this dividend. And dividend payment date: the actual date when money is credited to your bank account. Example with ITC: declaration date is March 15th and record date is April 5, and ex date will be April 4, payment date will be April 30. So if you hold ITC shares on April 5th, you receive the dividend on April 30. Simple. So how much do you get? If you ask me how much do you get, then the answer would be that dividends are announced as rupees X per share. So example, ITC declares a dividend of rupees 7.50 per share. If you hold 500 shares of ITC, you receive 500 into 7.50, that is 3750 directly in your bank account. No selling, no action, just hold and receive. So coming to a dividend yield. What is a dividend yield? Dividend yield is equal to annual dividend per share divided by current stock price into 100. Example, ITC stock price, it is for rupees 450 ITC annual dividend. If you take rupees 7.50, dividend yield is equal to 7.50 divided by 450 into 100, which gives us 1.67%. Coal India stock price is rupees 450. Annual dividend will be rupees 25 and dividend yield will be equal to 25 divided by 450 into 100, that is 5.5%. So higher yield is equal to more income relative to your investment. But yield alone is not enough. You also need dividend consistency and business quality. Interim versus final dividend. So if we see, some companies pay dividends multiple times a year. Interim dividend paid before year end, usually in Q2 or Q3. Final dividend paid after annual results, usually in Q4 or Q1 of next year. Some companies pay both, like giving you income twice a year or more. Now coming to types of dividend stocks. Not all dividend stocks are the same. Let's categorize them. So, type 1 being high yield dividend stocks, that is 5 to 8% plus yield. So, these stocks offer very high dividend payout relative to their price. Examples: Coal India being 5 to 6%, Hindustan Zinc 6 to 8%, NMDC 5 to 7%, Vedanta 9 to 7 to 10%. Attractive for pure income generation, but often in cyclical sectors. Caution is that very high yield can sometimes signal a falling stock price. Always check business health. Next, we have type 2, that is consistent or dividend growth stocks, which has 2 to 4% yield growing over time. So these stocks offer moderate yields but increases their dividend every single year. Example: Infosys, TCS, HDFC Bank, Bajaj Auto, Hindustan Unilever. The magic. So the magic here is 3% yield today will give 8% on your original investment in 10 years. If dividend grows 10% annually, best for long-term wealth building, the buy and forget category. Coming to type 3, it is high payout PSU, that is public sector stocks. So government owned companies with a mandate to pay high dividends. Examples like Coal India, Power Grid Corp, NTPC, ONGC, Oil India government owns majority. That is, government wants dividends. It needs the revenue for budget. So result will be consistent high payout ratios, which are reliable income for investors. Next we have type 4, that is special dividend stocks. So occasionally companies pay large one-time special dividends from asset sales, exceptional profits, or cash surplus. Example: HDFC Ltd paid a special dividend before its merger. Not predictable, but can be very rewarding when they happen. Which type is best is the next question. So for beginners, start with consistent or growth stocks plus PSU dividend stocks. For income seekers, say take high yield plus PSU stocks. And for long term wealth, dividend growth stocks, which is patience, is the key. Next, we have best dividend stocks in India. So, coming to best dividend stocks in India, talking in 2026, which we have detailed analysis. Let me now walk you through the top diving or top dividend paying stocks in India with honest analysis of each. Coming to first being the Coal India Limited, CIL, sector mining or energy, and it's a PSU stock. So Coal India is the India's largest coal producer and one of India's most profitable government companies. Dividend track record being consistently paid dividends for 10 plus years, multiple interim plus final dividends each year, and annual dividend often exceeds 20 to 26 rupees per share in recent years, and at a stock price of rupees 422, rupees 460, gives the yield of approximately 5.5 to 6.5% per year. So why the high dividend is that the government of India owns 63% of Coal India. Government needs dividend income for its budget, and result being the Coal India is mandated to pay very high dividends regularly. Coming to risks, we have energy transition risk. Coal demand could reduce long term as India moves to renewables, and cyclic revenue being that coal prices can fluctuate with global commodity cycles. And the verdict is excellent for high current income, moderate long term risk due to energy transition. Next, we have second one being ITC limited sector. ITC Limited for the sector FMCG, cigarettes, hotels, agri. It's a private sector blue chip. So ITC is one of the India's most debated dividend stocks, but also one of its most consistent, because dividend track record being 20 plus years of consistent dividend payments, has never cut its dividend in this period, and recent annual dividends being 6.75 to 7.75 per share at stock price rupees 420 to rupees 460, where the yield approximately being 1.5 to 2%. But that's low. Yes, but ITC also gives you consistent 50 to 15 to 20% EPS growth, a stock that itself has appreciated significantly over decades, and dividends that have grown every year. So the real power is that if you bought ITC 10 years ago at rupees 200 and it now pays rupees 7.50 per share, your yield on original investment is 3.75%. So if you wait 10 more years, it could be 8 to 10% on your original cost. And the risks being regulatory risks on cigarettes, ESG exclusion by some institutional funds, and verdict being medium yield but dividend growth makes it outstanding for long term investors. Next, we have Hindustan Zinc, that is HZL sector. HZL and sector being metals or mining from Vedanta Group. So, Hindustan Zinc is India's only integrated zinc lead silver producer and one of the world's lowest cost zinc producers, and dividend track record being known for massive often special dividends, has paid some of the highest dividends of any Indian company in certain years. Yield has ranged from 6 to 12% plus depending on year and stock price, and 2023 to 24 has declared total dividends of rupees 29 plus per share at stock price rupees 300 to 340, that is core recurring yield of rupees 5 to 7%, with special dividends adding significantly more. Why? Because Vedanta, the promoter, needs cash. That is, HZL generates massive free cash flows, thereby dividends flow out. And the risks being cyclical metals sector, promoter driven cash extraction, both a feature and a risk, and its volatile stock price. The verdict is excellent for high income if you can stomach uh, the cyclicality. Next, we have Power Grid Corporation of India, the sector being power transmission and Navaratna PSU. So, Power Grid is India's central power transmission utility, a quasi monopoly or with government backing. So, dividend track record being very consistent dividends for 15 plus years. Recent annual dividends being rupees 10 to 12 per share at stock price rupees 280 to 320, and yield approximately 3.5 to 4.5% per year. Why reliable means regulated business revenue is guaranteed by the electricity regulator. Government ownership ensures dividend continuity. Power demand in India only grows, and this company revenues are structurally rising. Risks being interest rate sensitivity, regulated utility, and capex cycles can sometimes reduce short term dividends. Verdict: will be best sleep well at night dividend stock in India. Very consistent, government backed. Next, we have stock 5, that is NMDC Limited sector. It is NMDC Limited, the sector being iron ore mining. It is PSU. So NMDC is India's largest iron ore producer, directly supplying India's booming steel sector. So dividend track record is very high payout ratios, typically 50 to 60% of profit distributed as dividends, and annual dividends being 8 to 15 rupees 8 to 15 per share depending on profits, and at stock price rupees 200 to 240, where the yield approximately is 5 to 7% per year. Why it is good means India's infrastructure boom is equal to steel demand boom, which is equal to iron ore demand growth, which is equal to NMDC profits rising, and government ownership is equal to high dividend mandate. Risks being iron ore price fluctuation, dependency on Indian steel industry health, and the verdict will be good income plus direct play on India's infrastructure boom. Next, we have Infosys or TCS sector being IT services, which are large cap private. So India's IT giants and they are consistent dividend growers with impeccable track records. Infosys pays quarterly dividends unique in India, with annual yield 2.5 to 3.5%, and TCS has annual plus special dividends, massive buybacks supplement income, yield 1.5 to 2.5% plus buyback returns. Why include them means because these are quality growth companies that also pay growing in dividends, and their dividends grow at 10 to 15% annually. Stock price has also appreciated significantly with dual benefit, and risks being IT sector slowdown, global demand dependency. So verdict will be lower current yield but outstanding for long-term dividend growth combined with capital appreciation. Next, we have Bajaj Auto sector being automobiles and private blue chip. So one of India's most generous dividend payers among private sector companies. So dividend track record is annual dividends ranging rupees 120 to rupees 160 plus per share in recent years, at stock price rupees 8,000 to 9.5k, and yield is approximately 1.5 to 2%. But Bajaj Auto also does large special in dividends from cash reserves, has one of India's highest cash balance relative to market cap, and total shareholder return, that is dividend plus price appreciation, has been exceptional over 10 plus years. The verdict will be moderate yield but consistent growth plus special dividend potential. So let us see the dividend stock comparison table now. So if we see the comparison for the Coal India, which is mining sector, the approximate yield is 5.5 to 6%, 6.5%, and the consistency is very high, growth is low, and risk is medium. For ITC, it is FMCG sector has yield of 1.5 to 2%, very high consistency, high growth, and low to medium risk. Hindustan Zinc has is a metal sector in a yield being 6 to 12%, consistency medium, growth medium, risk also medium. Uh, Power grid has a power sector with yield 3.5 to 4.5%, consistency very high, growth medium, risk is low. NMDC sector is mining. Uh, Approximate yield will be 5 to 7%. Consistency is high, growth is medium, risk is medium. Infosys has sector as IT, and yield will be 2.5 to 3.5%. Consistency is high, growth is high, and risk is low to medium. Bajaj Auto, the sector is auto. mobiles, and yield will be 1.5 to 2%. Consistency will be high, growth high, and risk will be low to medium. Next, we have how to evaluate a dividend stock. So, before investing in any dividend stock, run it through these 6 checks. Check 1 being dividend yield. That is, current yield is equal to annual dividend divided by stock price into 100. Ideal range for India 2.7% and above will be 8 to 10%. Investigate why. The possibly falling price or unsustainable payout. Check for those. Check 2 will be dividend payout ratio. That is, payout ratio is equal to dividends paid divided by net profit into 100, which is ideal. Ideally, it will be below 75% and above 90% plus. Means company may not be able to sustain dividend, it profits dip. So very low, that is less than 20%, means company is reinvesting heavily. Not a bad thing, but less income for you. Check 3 will be dividend consistency. That is most important. Has the company paid dividends for 5 plus consecutive years without cutting? 10 plus years of uninterrupted dividends is equal to strong signal of financial health. Tools being check the dividend history, tab on screener.in or money control. Okay. Next, check for being earnings growth. Is the company's profit growing year on year? A dividend is only sustainable if the underlying profit supports it. So, on flat or declining profits plus high dividend payout is equal to danger signal. Next, we have check 5 being debit level. So, debit to equity ratio. So, prefer below 0.5 for dividend stocks, which is highly indebted companies may cut dividends during stress to service debt. Next, we have check 6, which is free cash flow, that is FCF, where the dividends are paid from cash, not accounting profits. And they check that FCF, that is cash from operations minus capex, is consistently positive and growing. If a company consistently pays dividends higher than its FCF, it's unsustainable. So, quick screening tool, use screener.in, that is a free tool to filter by the dividend yield, which is greater than 3% plus payout, which is less than 70% plus profit growth, which is greater than 10% plus debt or equity is less than 0.5%. So, that's about this. So this filter alone will give you a high quality dividend stock list to research further. Next, we have building a dividend portfolio. Okay, so let's see the strategy. Now let's talk about actually building a dividend portfolio in India. So the core satellite approach will be core 70%, stable, consistent, low risk dividend payers with Power Grid, ITC, Infosys, TCS, NTPC, HDFC Bank. So these form of income backbone will be reliable quarterly or in annual income. And next we have satellite, which will be there need to be 30%, where the higher 30% because it has high yield, moderate risk additions, and it has Coal India, Hindustan Zinc, NMDC, Bajaj Auto, and these boost your overall portfolio yield. Now coming to like building toward rupees 50,000 per month dividend income. So to earn rupees 50,000 per month, that is 6 lakh per year from dividends at average 5% yield, you need 1.2 crore invested at average 7% yield. you need 86 lakh approximately invested. So this sounds large, but it's achievable by starting early and reinvesting dividends. The DRIP, dividend reinvestment plan approach. So coming to the re, this plan, to earn rupees 50,000 per month, that is 6 lakh per year from dividends at average 5% yield, you need 1.2 crore invested at average 7% yield. That is, you need about 86 lakh invested. So we can do it. Like India doesn't have formal drips, that is dividend reinvestment plans, but you can manually reinvest every dividend received into more shares. So this creates compounding and your dividends earn dividends. So example of compounding being 5 lakh invested at 5% yield is equal to 25,000 per year. Dividends reinvest all dividends. So this will buy more shares here, more shares, and year 10 portfolio value at 12% total return, being 15 lakhs 52,924 year 10 annual dividend income. In annual dividend income will be like 77,646 per year versus original 25,000. So the sector diversification for dividend portfolio, if we'll come to that, then energy or power will be NTPC, power grid, coal India, which being 30%. Then we have FMCG or consumer, it will be ITC and HUL being 20%. Then coming to IT services, it will be Infosys and TCS being 20%. And banking or finance will be HDFC Bank with 15%. Metals or mining will be Hindustan Zinc and NMDC with 15%. So investment amounts for beginners will be starting capital of rupees 50,000, buy 2 to 3 stocks, starting capital being 2 lakh, then build a 5 to 6 stock core portfolio, then add systematically every month. Treat dividend investing like a monthly SIP. Okay, so now let us come to advantages. First one is real regular cash income. That is, money comes to your bank account every year without selling anything, unlike mutual funds where you must sell units to take profits. Next, we have second one, forces you to hold long term. So this dividend investors don't panic, sell during market crashes because their focus is on the dividend, not the daily price. So this naturally deals to better holding behavior and better long-term returns. Next, we have a signal of financial health. So companies that pay growing dividends for 10 plus years are financially robust, and the dividend history is one of the best filters for company quality. Next, we have compounding through. So, compounding through reinvestment. So, reinvesting dividends into more shares creates a snowball effect. So, each reinvestment buys more shares which pay more dividends, accelerating over time. And next we have inflation protection, that is, quality dividend growth stocks increase their dividends at 10 to 15% annually, well above inflation, and your income in year 10 is dramatically higher than year 1. If you come Next we have dual return, that is income plus price growth. So the best dividend stocks give you both regular income and capital appreciation, like ITC, Infosys, Power Grid all have delivered both over a decade. Next we have low stress investing, being you're not trying to predict the market, you're collecting income from quality business. So markets crashes are actually good. You buy more shares at lower prices and get a higher yield. Next we have works at any portfolio size because starts with 10,000 to 10 crore. So dividend investing scales with your capacity. Next we have disadvantages now. So coming to disadvantages, we have dividends are taxable in India. So in India, dividends received by individuals are added to your income and taxed at your slab rate, so at 30% tax bracket. So you pay 30% tax on every rupee of dividend. This significantly reduces the effective net yield, that is more in tax section. Then we have limitation 2, being high yield doesn't always mean good. So a stock with 12% yield could mean the stock price has crashed badly, and always check if high yield is due to a growing dividend or a falling price. Next we have dividend can be cut anytime. So dividends are not guaranteed. Companies can reduce or stop dividends if profits fall. Example, many companies cut dividends during COVID 19 in 2020. Next, we have lower growth than non dividend stocks. Like companies that pay out high dividends reinvest less. So, their own business growth may be slower. Higher growth companies like Zomato, Nykaa pay no dividends. All profits go back into growth. Next, we have dividend yield changes with price, because as stock price rises, the dividend yield falls. So, a rupees 5 dividend on a rupees 100 stock is equal to 5% yield. Same rupees 5 on rupees 200 stock is equal to 2.5%. So, new investors who buy at higher prices get a lower starting yield. Myth is that high dividend yield is equal to best stock to buy. Reality is dividend yield is one metric among many. Evaluate consistency, payout ratio, earnings growth, because they all matter equally. Next, we have taxation, that is most critical section. So this is the section that changes how you think about dividend investing in India. Pre 2020 versus post 2020 taxation, which has important change. So before fiscal year of 2020 to 21, dividends were tax free for investors. Like company paid dividend distribution tax, that is DDT. From fiscal year 2020 to 21 onwards, DDT abolished. That is, dividends now taxable in hands of investors at their applicable income tax slab. What this means is that 0 to 5 lakh of is 0%. So if your tax bracket is 0 to 5 lakh, it is 0%, and tax on dividend will be 0% plus 4% cess. And if it is 5 to 10 lakhs, then it will be 20%, then 20% plus cess. And above 10 lakh will be 30% and 30% plus cess. So TDS on dividends. So if your total dividends from one company exceeds 5,000 in a fiscal year, company deducts TDS at 10%. So if you're in the 30% bracket, then you pay the remaining 20% via advance tax or ITR. So if you are in 0% bracket, then claim TDS refund via ITR. So capital gains when you sell. So holding period will be under, if holding period is under 12 months, tax will be STCG at 20%, and if it is over 12 months, it will be LTCG at 12.5% on gains above rupees 1.25 lakh per year. So tax efficient dividend investing is that if you are in 0% or 5% tax bracket, dividend investing is outstanding. If you are in 30% bracket, consider whether the after tax yield justifies versus other instruments, and invest through a HUF or spouse account in lower bracket to reduce the dividend tax burden legally. Coming to ITR filing, the dividend income will be like report under income from other sources in ITR. So if TDS deducted, then you claim credit in ITR and file ITR 1 if only salary plus dividend, or ITR 2. Okay. Next we have how to find, buy and track dividend stocks. So if you see how to buy, find and sell dividend stocks, then you like How to find good dividend stocks? Let's start with that. So tool 1, you need to use a tool that is screener.in, that is screener.in, which is free and most powerful. Go to screener.in, create account, which will be free. Use query builder filter criteria, and dividend yield will be greater than 3, and payout ratio will be less than 75, and sales growth will be greater than 10, and return on equity will be greater than 15. Okay, so use this query. Then this produces a curated list of quality dividend stocks. Then bookmark it. Next, we have tool 2, that is money control or ET markets. So search any stock, click financials, go to dividends tab, then see complete dividend history. Next, we have tool 3, that is NSE India website, that is nse.india.com, which has list of companies paying dividends. Sort by yield. So how to buy them? Open Zerodha or Grow or Angel One. Search the stock name or symbol. Place a buy order before the ex dividend date to be eligible. Money for dividend arrives on payment date. No action needed. How to track is create a Google sheet. Stock, shares, cost, price, dividend or share, annual income update quarterly. So track total dividend income versus investment. Goal is watch your annual dividend income grow every year. Coming to free dividend calendar, trend line, that is trendlyne.com, has a free dividend calendar. So it shows upcoming X dates and payment dates for all stocks. So bookmark this, it's incredibly useful for timing dividend collection. Now coming to comparison with dividend stocks versus other investments, let's see for factor. If you come to regular income, dividend stocks are annual per sem. FDs are monthly, REITs are quarterly, InvIT are quarterly, growth stocks are nothing. Coming to capital growth, dividend stocks are high, FD is none, REIT has moderate, InvIT has low, and growth has very high growth stocks. Coming to yield, dividend is 1.5 to 7%, FD 6.5 to 7%, REIT 6 to 8%, in which 8 to 12%, and growth stocks nothing. Inflation in dividend stocks strong, FD weak, REIT yes, in which yes, and growth stocks it is strong again. Tax efficiency, dividend stock has slab rate, FD no slab rate, REIT complex, InvIT complex, growth stocks LTCG. Coming to control, dividend stocks has you choose, FD has nothing, REIT has manager, InvIT has manager, and growth stocks has you choose. The like REIT and InvITs also don't have any managers. Okay. Next we have, because in like dividend stocks and growth stocks you have control, you can choose and liquidity, dividend stocks yes you have exchange um, uh, penalty, like FD has a penalty, REIT and InvIT and growth stocks all you can, yes you have liquidity and you can exchange them. Risk is for a dividend FD, it will be like for dividend risk will be low to medium, FD very low, REIT and InvITs low to medium, and growth stocks it is medium to high. So hybrid portfolio idea is dividend stocks 30% plus REIT 15% plus InvIT 10% plus equity growth mutual funds 35% plus growth or like gold or debt will be 10%, which will be equal to income plus growth plus stability, which is perfectly balanced. Coming to current affairs, like If you see why in 20, why is 2026 a great time for dividend stock investing in India? First is that India's corporate profit cycle at peak, that is Nifty 500 companies profit to GDP ratio at multi-decade highs. Like more profits is equal to more dividends, and PSU companies like especially are swimming in cash. Next, we have PSU dividend mandate strengthening. So, Government of India in fiscal year 2025 asked PSU companies to maintain minimum payout ratios. Coal India, NTPC, Power Grid, ONGC, all under pressure to pay more dividends. So, direct benefit for retail investors holding these stocks. Next, we have RBI rate cuts, increasing dividend attractiveness. So, as FD rates come down, dividend yields of 5 to 7% look increasingly attractive. Money that was in FD is gradually rotating into dividend stocks, and this trend drives prices up and makes early entry valuable. Next, we have India's capex cycle benefits PSU dividends. So, government's infrastructure push means PSUs are earning record revenues. So, record revenues means record profits and record dividends thereby. So, that's also another reason. And fifth and last reason is IT sector buybacks plus dividends. So, Infosys, TCS, HCL all running massive dividend plus buyback programs. So buybacks reduce shares outstanding, which has that remaining shareholders get higher dividends per share automatically. So now if we see the final summary, what are dividends? Like dividends are they are share of profits paid by companies to shareholders, which are regular passive income. The key dates will be X date, must own before this, record date, and payment date. Third point is to like best dividend stocks 2026 will be Coal India, ITC, Power Grid, Hindustan Zinc, NMDC, Infosys, Bajaj Auto. Next, how to evaluate? So we need to take yield plus payout ratio plus consistency plus earnings growth plus free cash flow. Next, we have tax. So added to income taxed at your slab rate, TDS at 10%, above rupees 5,000 per company per year, and file as income from other sources. Next, we have build a portfolio. So, core stable dividend stocks will be 70%, plus high yield stocks will be 30%, plus reinvest dividends for compounding. Okay. Now, how to find? How to find is, as I told you, the tools screener.in, money control screener.in, and money control dividend history tab, and trendline dividend calendar. Okay, these are the tools. Next, why now is PSU dividend mandates plus FD rate cuts plus record corporate profits will give a perfect entry environment. Now, as you have been patient with me now and till now and been here this long, so the dividend investing is not exciting. It won't go viral. Nobody will brag about it at parties. But 5 years from now, when your quarterly dividend income is covering your phone bill, your EMI or your rent, you'll be glad you started today. So hit that like button if this video helped you to understand dividend investing. Drop in comments what's the first dividend stock you'd like to research, and subscribe and turn on notifications. Detailed finance guides like this one for reaching them out for one every week. So share this with someone who invests in stocks but doesn't know about dividends, and you'll be doing them a real favor. So take care. See you next time. Thank you. Bye bye.